끄더래.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We talk as if tariffs drive the entire U.S. economy. They don't. Goods subject to tariffs represent 9% of GDP. I don't want to minimize the impact, but tariffs don't drive the entire U.S. economy. The consumer is doing just fine. Hey, we have fiscal spending that, in our minds, is going to be stimulative.
That was Sebastian Page of T. Rowe Price as we try to assess just how important some of these tariffs are going to be for the trajectory of growth going forward for the U.S. economy. Right now in markets, we do see a bit of softness as markets digest the new tariff rates, as well as sort of disappointing news from Amazon. It's hard for me to call it. They did beat. You see S&P futures lower by about 1%. You could see a more pronounced weakening in the Russell 2000. Really, the dollar strength has been notable, the sort of reassertion of whether we are seeing American exceptionalism once again. 114 on euro dollar, and yields marginally higher, 3 basis points higher on the 10-year as people look ahead to potential resilience in the labor market and the U.S. economy. Turning to our top story out of Washington, D.C., President Trump announcing new tariff rates around the world set to take effect next week. I am so pleased to say that U.S. Trade Representative Jamieson Greer is joining us now. Jamieson, Ambassador, thank you so much for being with us. I know you've been incredibly busy. I can imagine you haven't slept much. I am curious how much we're seeing the end of negotiations or the beginning of the end, as there still seem to be some loose ends to be tied up.
Well, I would say that, we've spent the past 120 days negotiating with dozens and dozens of countries, and with some of these countries, the deals have been good enough that the president's been willing to accept them. With other countries, they're just going to have a tariff. But we have, you can look at some of the information that's gone out there. We have fact sheets. We have a joint statement with Indonesia that gives some details. We'll be finishing the paperwork in the next, weeks and maybe a couple of months. But these deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system. And so we'll be, finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
Ambassador Greer, can you help us understand how you landed on some of these rates? Specifically, a country like Switzerland, it went from 31% on Liberation Day, April 2nd, to now 39%, even though you and your colleagues were in negotiations with the Swiss trading partners.
Sure. Well, so first of all, the rates are largely determined by the trade deficit of a country with the United States and what the country's willing to do to address that trade deficit. Switzerland, this is surprising to some to hear, but we have a nearly $40 billion trade deficit with Switzerland for a country of 9 million. Now, we value our relationship with Switzerland, certainly, but during our discussions with them, we weren't able to reach agreement on the best way to reduce that trade deficit. At all, right? They ship enormous amounts of pharmaceuticals to our country. We want to be making pharmaceuticals in our country. So this is a challenging situation, and so we have high tariffs, not just on Switzerland, but many countries where we weren't able to fully resolve a path forward on reducing the trade deficit and opening markets.
My understanding was that the U.S. and Switzerland actually had a negotiated text, and it was just waiting on sign-off from President Trump. Is that accurate?
I think that's an overstatement. I mean, the reality is all of these countries, you trade back and forth paperwork, and then you take it back to your leaders to get guidance from them. And so nothing's agreed until everything's agreed. That's what every trade negotiator knows. So the reality is we negotiate with lots of countries. Listen, there are a lot of countries that didn't get a deal that we've been negotiating with. And of course, they all want a deal. They all want a deal with the United States. So I can understand that folks may want to try to manifest a deal in the last minutes, but we just have to do what's right for America, and the president understands that too.
I'm thinking of other countries like Taiwan, which that rate went down, India, Switzerland, of course, we know you are in negotiations with. So between now and August 7th, could some of these countries that you spent a lot of time with your counterparts get a deal?
Well, that's not my focus. I feel like we've been able to get everything set on August 1st. Of course, any country that wants to talk to us, they can always talk to us, and I'm sure some will be eager to find ways to reduce the deficit, open their markets, et cetera. But we're really focused right now on implementing the deals that have been reached.
Well, on implementing those deals, Representative, you mentioned that you would be looking and monitoring them for any violations. How will this administration judge what is a violation and what the consequences of that would be?
So, for example, we put out a fairly detailed joint statement with Indonesia, and we're finalizing the underlying agreement. And in there, you can see that they've made commitments on tariff levels, where they're going to remove all of their tariffs. They've made commitments on non-tariff barriers with respect to, agricultural inspections and the way they treat certain digital trade. And so our office, which has hundreds of people, the Office of the U.S. Trade Representative, they watch this and they make sure that Indonesia actually does what it's supposed to do. And if they don't, the president has his tariff authority. I mean, all of the deals are premised, and the modified rates for these countries are premised on them actually opening their market, making the investment and purchase commitments they've agreed to. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here.
Ambassador, right now there are a number of countries coming out and saying this is part of a negotiation, and they plan to keep talking with the team over in the trade organization and trade representatives from the United States. Is that just messaging to their own political constituents, or is that reality?
Well, listen. They certainly have their domestic constituents they have to talk to. You can be sure that I woke up this morning to a number of trade ministers texting me and emailing me, and I'm sure they're reaching out to my colleagues, Secretary Letnick, Secretary Besson, et cetera. And my job is to talk to these folks. I'm always going to talk to these folks, and if they have proposals, I'll talk to them and I'll brief the president. We're focused on implementation and doing what's right to change the trading system to one that benefits American workers.
How much are you also hearing from U.S. companies concerned about certainty and whether they're going to get clarity on exactly what the rates are going to be, whether they will stick, whether there will be adjustments, and how some of these things will work with transnational shipments of getting penalized 40%?
So with respect to certainty, President Trump has been talking about a new tariff program for literally years. Decades in some instances. He has tariffs from his first term that are still in place. So sometimes when companies say we want certainty, what they mean is we want a different outcome, right? And by putting, the market has baked in a lot of the tariffs we've put in. The new tariffs that we issued last night are firm. That's why we put it out in a very clear list. Everyone can see it and understand. With respect to transshipment, that's always been illegal. And so we're just going to put an additional 40% tariff on that. So, I understand that there are going to be edge cases where companies have to change their supply chains, and no one wants to do that. They just want status quo. but we can't have the status quo. The status quo is what led to offshoring and the loss of some of our key industries. So during that supply chain shift, that can be challenging for some companies. And I talk to a lot of these folks. I want them to understand the president's trade policy. I want to hear about any unintended consequences. But the president's trade policy is moving forward, and we're shifting from a 70-year policy based on purely efficiency to a new policy based on fair and balanced trade, and the world is agreeing with us.
Ambassador Greer, what about the unintended consequences of what's going on with the sectoral tariffs on autos? The Ford CEO was on Bloomberg television yesterday talking about the price disadvantage compared to auto companies if they're making a car in Japan because of the input costs of 25% on those inputs that they need to make their car coming into the United States versus the 15% rate that Japan now has. What's the point of the auto sectoral tariff if basically it's going to be bilateral now with country by country?
So first of all, there are only a handful of countries that export cars to us, right? It's essentially, Germany, Japan, and a couple of countries of the European Union. We also have Canada and Mexico, and we had our domestic producers, choose over a couple of decades to offshore a lot of that production to Mexico. And so naturally, there is some challenge as they continue to reshore that, and we understand that, right? I mean, our goal is long term. We're not looking at quarterly earnings as policymakers. We're looking at a way to make sure that we have a strong, robust industrial base here that provide good jobs for our workers and support the national security. So, we're in constant contact with the domestics, with the unions, and everybody. And, I understand that the auto companies are receiving a credit for content that's made in America, which is how it should be. That's what we're trying to incentivize.
When you're looking and you're thinking long term, are you preparing for a Supreme Court ruling against using IEEPA for these tariffs? And if so, what's the plan B?
So the case is at the federal circuit right now. We had the arguments yesterday. Lots of questions, a lot of preparation. DOJ did a great job. We had a great team out there. We feel very confident in the case. If there's still questions coming out of the federal circuit or further litigation that goes to the Supreme Court, we're confident there that this statute clearly says the president has the authority to regulate imports. That's the language. No, not my words. That's the statute's language. In case there's a national emergency, the president's declared a national emergency. So we feel confident, if it goes the other way, then we'll manage that. The reality is the countries understand the type of leverage that President Trump has created. That's why they're doing these deals, and they're going to stick regardless of what happens in litigation.
That's where I wanted to finish, and we just have a couple of minutes. We are out of time with you, I know, but I am curious what the game plan is. Should there be some sort of overruling of IEEPA? Do you already have Section 232 and others lined up?
Well, listen, we always have all kinds of plans, and I'm not going to go deep into our strategy here, mostly because we're pretty confident on the current plan. But we will do whatever it takes to make sure that the president can continue to rectify the trade deficit and change the global trading system. I mean, this is a historic thing. This is once in 100 years that you have the chance to reorder global trade like this, and we're doing it, and we'll use whatever tools are necessary to do it.
U.S. Trade Representative Jamieson Greer, thank you so much for being with us. I'm not sure when you sleep, and we've been talking about that with you and Scott Bessent as well. Ambassador, thank you for your time. I appreciate it. Really a slew of changes at a time when there are some real questions over what the ramifications will be, but historic in terms of magnitude, that's for sure.
Oh, yeah, historic. These are the highest tariff rates we've seen since the 1930s. What was interesting, he said that a lot of these countries want to manifest deals now. I want to know, I think the market wants to know between now and August 7th, I think the market's trading on this, they are still in negotiating mode. He said he woke up to a number of text messages from his counterparts, from negotiating partners, wanting to get to end. Potentially, is this the final moment where we can see these concessions the administration has wanted from places like India, maybe when it comes to things like Russian oil, from Switzerland, maybe things like pharmaceuticals, from Taiwan when it comes to semiconductors? Is this the final stretch for some of these big trading partners?
Meanwhile, we are just about a minute away, less than a minute away from the payrolls data, and a real question, Danny, about how much the ramifications from any of what we've seen on the headline turmoil that we've seen has filtered into labor.
It hasn't filtered through yet. Will it start to change? That is a question. But the fact it hasn't filtered through yet means that a lot of this market has been able to look through some of the drama and not necessarily trade it because it's not showing up in the economic data quite as much as we expected.
What we are expecting is 104,000. That is the median in a survey of economists for the number of jobs created in the month of July. We're also expecting expecting the unemployment rate to tick up by 10 basis points, 4.2% from 4.1%. The whisper number is 120,000. The potential of what is the break even going into that right now. S&P futures are lower. Right now, let's head over to Michael McKee with the numbers. Mike, what do you see?
Well, we got a very disappointing number here, and this is going to get Wall Street's attention. 73,000 jobs created during the month of July. The forecast, as you said, was for 104, and we came down from 147 last month, looking to see what the revisions are. Right now, the three-month revisions add to payrolls by 35,000, so that has to be factored in. Private payrolls, 83,000. They were 74,000 last month. So it looks like government has subtracted from the overall level of jobs, and that would be a rebound or a going back basically to the seasonals issue that we saw in June. Unemployment rate, 4.2% as forecast. We'll look at what the three-digit number is in just a second. Average hourly earnings up 0.3 as forecast. Average hourly earnings on a year-over-year basis at 3.9%. They were 3.8% the month before, so it looks like a little bit of a gain overall for people. I'll dig into this some more and let you figure out how the markets are reacting to this disappointing headline number.
Mike, that sound that you hear, that whoosh, is the two-year yield plummeting, and that is what we're seeing, down more than 10 basis points in response to this weaker than expected number. You can see equities have maintained some of the losses that they saw from earlier, but across the board, a bid into bonds is the big trade. 10-year yields down 5 basis points. The two-year yield, this really is the key moment, down 12 basis points to 3.84% as people take a look at what this labor market report means for the Federal Reserve. In the currency space, we had been seeing quite a bit of dollar strength on expectation that the Fed would have to remain really strong with policy. We see a complete reversal, the euro bouncing versus the dollar, 114.81, as people assess that maybe this will be a Fed that will get pushed into cutting rates sooner and faster. Really, the idea that you could see the number come in softer, as well as the unemployment rate also ticking just slightly higher, concerning, or at least provoking a response that would imply more rate cuts. Mike, you've had some time to dig through some of the numbers. Really notable to me that the change in private payrolls came in slightly lower than expected, but manufacturing so much lower, actually a contraction there. What stands out to you?
Yeah, you've got 11,000 jobs lost in manufacturing, and we had seen signs of this coming in some of the ISM reports, and we do get ISM for July coming out at 10 o'clock this morning. But it does suggest that companies in manufacturing at least were not ramping up at all. They've lost a few thousand. Construction, only 2,000. There were 13,000 that were supposedly found by ADP in their numbers on Wednesday. So construction, not really a surprise given the circumstances and what we've heard about construction overall. Service-producing jobs, 98,000. That's a low number, but in line with the fact that service-producing jobs are the majority of jobs in the economy. And then, of course, the number that really has set the tone here is the government jobs. We see 12,000 jobs lost at the federal level, and that's going to just start picking up because a lot of people who left the federal government under DOGE got some sort of severance, and they don't count as unemployed as long as they are getting severance. So we'll see more of that. Overall, government, including state and local, down 10,000, and that is a rebound from last month's 74,000 jobs created, most of those in state and local government because of education, and economists think that was mostly because of a seasonal adjustment problem. I didn't mention earlier, but we should point out that the average work week rose by 0.1%, 34.3, and that may suggest that even though companies were laying some people off, to keep up with business, they had to work others harder. So a little bit of a buffer on the other side.
As you speak, Mike, we're seeing the two-year yield just plunge that much lower. Michael McKee, thank you so much. So if you are just joining us, here's the state of where we are. We did get the non-farm payrolls report for July. 73,000 is the number we got. 104,000 was the expectation. We see that increase in the unemployment rate as expected from 4.1% to 4.2%. We did see average hourly earnings still go up by 0.3%. But as you parse into the numbers, here is what is accelerating that downward shift in yields, that upward shift in expectations for Fed rate cuts. The revisions in non-farm payrolls for the month of June came in at 14,000. That is downgraded from 147,000. I had to do a double take, Danny, if that was accurate or not. But you really see that downward revision in the prior month coming into play in a massive way.
June goes down to 14,000. May goes down to 19,000. That makes 73,000 today look all that much more weak. I think that's going to be the thing that catches a lot of attention this morning, not necessarily the number that just comes in, because if the revisions continue to stack up that way, what is 73,000 actually? Is that even a lot more weak?
Neil Dutta of Renmac goes right to Twitter. Waller looks vindicated. It was Christopher Waller that on this program talked about just weeks ago, before he made this descent, that he is seeing cracks in the labor market. And we are seeing that today when it comes to this unemployment report.
Yeah, and I'm sure that we'll get some more Truth Social posts on this. Joining us now is Stephanie Roth of Wolf Research. Stephanie, you've had a couple minutes to look through this. Is this a terrible jobs report, or is this a little bit more complicated?
It's pretty bad, especially in the revisions. I think that's the biggest thing. I mean, the 258,000 of negative revisions in the prior 2 months is pretty eye-opening. Of course, we're all watching the unemployment rate because that's what, for a couple of reasons, that's what Powell is telling us to focus on, which remains, up a little bit, but fairly steady. I think what we're seeing is the massive impact from immigration having important implications on the labor market, and that's what's driving at least some of these negative revisions.
When you look at the market reaction, though, it looks like they're pricing in September and October for Fed rate cuts. If we see another weak job report, is that what you would expect?
I think there's certainly a chance of that. That said, the inflation data are also going to be pretty elevated in the next couple of prints. So it makes it a really tough backdrop for the Fed in this landscape. And this is something we've been warning our clients about for quite some time, that risks are quite elevated over the summer because we're going to be in an environment where immigration is going to have very negative impacts on the net hiring of this economy. The unemployment rate might remain okay, and inflation is likely to be quite elevated. And that's a really toxic backdrop for the Fed to be able to cut.
We do have, though, 73,000 for non-farm payrolls, weaker than expected, 4.2% unemployment rate ticking higher. What is the line in the sand for this unemployment rate that Jay Powell is saying is what he's mainly looking at, the main number?
I think we're talking somewhere between 4.3, 4.4, 4.5 for sure they'd be cutting, but I think it has to continue to creep higher throughout the course of the summer in the backdrop that inflation is going to be quite elevated.
Is this Waller vindicated, what we're looking at right now? Is this the dissenter saying that the labor market is weak? Is this a hat tip, a vindication of that?
I still kind of think that it was a little bit political. However, the data do happen to be consistent with that message.
So if it's consistent with that message, but it's still political, how much weight can you put into that? If they continue to go forward, and you have President Trump, who was on Truth Social this morning saying that the board needs to take over, that they should be the ones dictating policy. If you start to get more of the dovishness from the board, do we have to continue to write it off as political? Do we just put less weight in it from here on out?
I think if you see other members continue to get more dovish, I think that's important. We all knew that the dissents were going to come from those two board members, right? So if you start to hear more dovishness from the rest of the committee, I would imagine Powell will also feel the same way, because that would be consistent with the actual data. Those two members in particular were known to be, having some sort of more political leanings to some extent in recent times. The rest of the members, if they start to become more dovish, I imagine Powell will be right alongside them. And that will be because the data continue to show that the employment backdrop is weakening.
Meanwhile, we're looking right now at markets, the two-year yield continuing to fall down 15 basis points to 3.8%. You have seen it come in even more. I just wonder if this really does set up September in a way, Stephanie, that is unassailable in terms of cutting rates, given the fact that especially the revisions, that tends to be a leading driver of the direction of travel. Isn't this something saying September has to be back on the table in a massive way?
Yeah, I think that's totally really fair. And if you look at the details within the household survey, the main driver of the sort of the softness this month in employment was foreign-born population. So I think this is exactly what we're seeing, the massive implications of the immigration policy having effects on the labor market.
Stephanie Roth of Wolf Research, thank you so much for being with us on this non-farm payrolls day on this Friday. I do want to get back to Michael McKee, who's been parsing through all of the details. Mike, what have you found as you've gone through it?
Well, Stephanie was just talking about the issue of immigration and how that might have affected the numbers overall. We did see a drop in the labor force of 38,000 and a revised drop from last month of 130,000 in the labor force. Now, of those who dropped out of the labor force this time, 341,000 in the foreign-born category. So a major drop in the number of people who are either legal or undocumented in their participation in the labor market. And that, I'm sure, has a role to play overall in what we're seeing now.
Mike, stay close. I'm sure you'll get more as we parse through all of that. Joining us now is Michael Collins of PGIM Fixed Income. Really fascinating point there by Mike on the immigration side of things. From your perspective, how conclusive is this labor market report about September and a rate cut then, and frankly, about deterioration in the U.S. labor market?
Yeah, Lisa, good morning. Right now, there are 2 full cuts, again, priced in for the rest of this year from, only about 35 basis points priced in an hour ago. So big shift, obviously, in expectations. And I think that does make sense. I think it is justified. But this is a trend that Powell talked about actually a lot in his press conference that we've been talking about. In fact, we discussed it a month ago, Lisa, that maybe we're in a world, given the immigration and deportation policies, that a 0 to 50,000 monthly gain in jobs is the new normal. That's the new run rate. And here we are with those revisions, as you pointed out. We are kind of in that world. Interestingly, again, as Powell pointed out, the unemployment rate is pretty sticky. The hours worked ticked up, the earnings, the wages ticked up, right? So there really aren't signs that the labor market is weak, that there's a big offset in supply and demand. It's just that the supply has shrunk a lot, and it will continue to. And it's, obviously the government jobs is a demand story, but we're just kind of decelerating into a lower run rate of jobs, which of course translates into a lower run rate of GDP, right? If you look at consumer spending so far in the first 6 months of this year, Lisa, we're running just below zero, right? Real consumer spending, which is obviously correlated to GDP. So we're kind of in this really low growth world right now that we've been expecting.
Well, the participation rate is down. As you say, unemployment rate up in July, despite the exit of people from the job market. Isn't that worrying for the Fed? Are they potentially behind the curve right now?
It really depends, right? This is the conundrum that the Fed has, and I actually give Powell credit for talking about this, that if job growth is weak, but the unemployment rate, the balance between the supply and demand for jobs isn't that out of whack, meaning the unemployment rate ticks up to 4.5 and stabilizes there, that's something I think the Fed would generally characterize as relatively full employment. I think it's when it starts to shoot toward 5, and certainly if we see a 5 handle, they'll probably be cutting in earnest, not talking about 25s and 50s, but getting that funds rate down to 3 really quickly.
Even so, Mike, just looking at some of the details, it looks like healthcare accounted for 75% of the gains that we saw in this employment report. It was the main engine of growth. Is there a concern about the breadth of jobs being added? Should we add that to the ledger of reasons to be concerned about this labor market?
Yeah, absolutely. And this is something that certainly my colleague Tom Porcelli has been speaking with you about for months now, that if you take away government jobs in healthcare, i.e. the kind of non-cyclical, structural jobs, the cyclical job growth has been really weak all along throughout the whole year. And this is just really a continuation of that trend.
So what do we do from here, Mike, if we are still in this period where there is some weakening, but it's not weakness? The rally that we're seeing in the front end, is that something that you'd want to chase at this moment?
Yeah, you buy bonds, right? I mean, it's a big, beautiful bond market, and returns have been substantial, and they're going up, right? Yields are really high, and we've been certainly advising clients, take advantage of these rates while they're high. I mean, the old adage is don't fight the Fed. My new tagline is don't fight the triumvirate, right? You have a president, a Treasury secretary, and ultimately a chair of the Fed that all think rates should not be, again, 25 or 50 basis points lower, but potentially hundreds of basis points lower. And I think that maybe will be realized over the next few years.
Mike, certainly people are buying bonds today. We can see that across the curve, although much more so on the front end. When you say buy bonds, I am curious which bonds. At what point you can really start to extrapolate out longer term, 10-year, 30-year rates and say it's a good time to lock that in at a time where there still are longer term questions about the tariff rates that we got last night, how long-term inflationary they'll be, especially if the Fed is prompted to cut rates.
Yeah, I mean, really across the whole curve. Obviously, as you're seeing today, that 2, 5, 7, 10-year, that kind of short intermediate part of the curve comes crashing down the most. That's where you get the most bang for your buck, Lisa. Meaning, you don't have to take a lot of interest rate risk to get a lot of benefit. But the whole curve, right now the funds rate that's priced in for the rest of our lives is 3%. Meaning the Fed gets to 3 by the end of 2026 and keeps it there, and actually increases it a little bit for the next decade. What's not priced in is a 2-handle or a 1-handle funds rate, right? So that realization could cause the whole curve to kind of come crashing down. So you don't want to just lock in a 2-year here, because then you have 2 years of duration, 2 years of reinvestment risk effectively. And we've been encouraging investors to inch out on the curve and to extend duration, maybe not, go absolutely long to 30-year, but add duration.
Stephanie Roth of Wolf Research still here, and I'm looking right now at some of the internals of this data, and it includes average hourly earnings that ticked up to 3.9% from the previous 3.7%. You can see right now across the board there are still signs that things are solid. Even the unemployment rate, yes, it ticked up, but not to the significant degree that some people were worried about. What is the inflationary risk here longer term at a time when the Fed is being prompted to cut from a number of different reasons? And there still are these tariffs in the system.
Yeah, this is a challenge, because the data that we're seeing largely appears to be driven by immigration, and that actually tightens the labor market for blue-collar workers. So what we might see is a labor market, which is something that was kind of known heading into this event, but it's now the reality. It's kind of painful, because what we're seeing is job gains that have slowed down tremendously. It results in upward pressure on wages, and then upward pressure from tariffs. So it's like a stagflationary type of shock, which we're starting to see play out in the data. It's just a really complicated mix for the Fed to kind of deal with from here. So it looks like the labor market is okay. It's not as weak as these numbers today suggest. This is largely driven by immigration and an economy that's hanging in there.
Mike, to that point, maybe the economy is hanging in there, but on the margins, is this buy government bonds, sell corporate bonds?
Corporate bond spreads, as as we've all been talking about, are really tight, meaning you're not getting a lot of extra yield to buy corporates and high yield bonds. And obviously you're seeing a little bit of a knee-jerk reaction, a negative reaction in the stock market as well. And this, this whole tariff theme is definitely one of not only inflationary, as we just talked about, the stagflationary risk is real, but it can certainly result in margin pressure for companies. And I think that is still to come. And I think we are starting to see some early evidence of that. And obviously that could put some pressure on corporate earnings. That could put some pressure on credit quality and on corporate spread. So yeah, I think higher quality bonds and adding duration are the two themes we've been sticking here. The big question for the Fed, right? And Stephanie, you kind of talked about this. If let's say growth is 0 and the unemployment rate is 4.5 or 5, but inflation is at 3. What does the Fed do in that world, right? That kind of stagflationary world. And my gut is, the Fed and even Powell, who is a labor market dove, would err on the side of saving the economy, saving jobs, saving the labor market, and write off this inflationary risk as being a one-off. So I think that's the kind of the risks, the way they're skewed.
Mike Collins of PGIM Fixed Income, thank you so much for your time. And before we got this number, we saw a 40% chance of a rate cut being baked into the market for the month of September. And right now we have a 71% chance of a rate cut in September. Joining us now is Jeff Rosenberg of BlackRock. We heard there from Mike Collins, buy bonds. Is that your takeaway?
Well, it's certainly the market takeaway because the market's repricing September, and it makes a lot of sense, and you guys hit on it, and I think it is the takeaway from today's report, which is it's the revisions story. Remember, there's been this undercurrent of a debate about whether non-farm payrolls in the labor market report is really mismeasuring the deterioration, and you see that in these first prints versus the revisions. Waller's talked about it. It's a little bit of vindication here, and that's basically saying his argument may hold sway or convince more people to come on his side of the argument. And, you know, maybe they missed the opportunity in July, but it certainly raises the odds that you get it in September. And that's why you're seeing the big move, as you pointed out, in the front end of the curve.
Well, the president agrees with you. He took to Truth Social and said strong dissents on the Fed board and will only get stronger. Given the revisions, the downside revisions, is this now a trend of this fragility we're seeing in the labor market?
Well, it was one of the numbers that Mike highlighted at the beginning. You know, when you take the revisions into account, you know, the 3-month average change on non-farm payrolls drops from 150,000 average, which is really a very, you know, pretty strong labor market, to 35,000, which is, you know, a dramatic shift. Now, as Mike just mentioned, you know, maybe we need to reset what we think is break even. But with the revisions, it's a dramatically different picture to what the labor market is saying. And as also Mike was talking about, you know, you have a pretty strong year-over-year average hourly earnings figure, wage inflation. You know, the market is not caring about that because I agree with Mike. I think in the debate between the dual mandate of inflation versus full employment, they're going to err on the side of full employment. And that's why, again, I think you're seeing this big move in the front end of the curve, but despite, you know, what we're not really talking a lot about, which is the wage number.
Yeah, Jeff, I just wanted to jump in because we had heard from Powell this week, who de-emphasized the non-farm payroll numbers themselves and said, pay attention to the unemployment rate. And we were just talking with Stephanie about this idea of it being impacted more by labor supply and things like immigration. So given that, couldn't you say maybe for this bond market, I shouldn't get over my skis in joining this rally because we did have things like PCE yesterday, which showed a stubborn rate of inflation?
Yeah, it's a really good point, and he did focus on that, and the unemployment rate, you know, ticked up 1/10, and that was kind of aligned with expectations. But he also said in that press conference that the slowing in the labor markets, even if it's both demand and supply with the equilibrium, raises the risk that the downside risk would be to labor markets. It was a little bit of a tell on, yes, we're in equilibrium now because you're getting both the supply and the demand side falling, but the risk is that the supply side sort of stops falling and the demand side continues. And I think that's kind of what the market is looking through here, particularly around this trend with the revisions, you know, more accelerated than, say, what we've seen in terms of labor force participation, which you mentioned a minute ago, which actually ticked down here again 1/10. But maybe you start to see that stabilize while the demand side doesn't stabilize, and that's the risk that the market's pricing in right now.
Jeff, not all markets are pricing in things equally. I just pulled up what the future session is doing. You actually, just looking at the line chart, would not even have any idea that we had any big economic piece of data come out. S&P 500 futures are basically at the level they were before. Is this a market that's not paying attention to the jobs numbers, or it's just not bad enough for them to react, or maybe it's smooth sailing because it means that we could get cuts? What do you make of how risk is not reacting?
Well, you know, and I looked at some of the futures, and they looked like they were reacting and down. I think when you look cross-market, you know, we talked a lot about this earlier this week. You got to be a little bit careful about reading into the equity market. You know, this is very much sort of a macro conversation, Fed policy, macroeconomic performance. The stock market is not the economy, and the stock market is not even the S&P 500. It's really the S&P 7 or 6. And then you've got the 493. There's tremendous differential. Look at sort of small cap performance versus, you know, S&P 500 performance, which is, again, it's sort of more dominated by the tech story. So those stories, and we're in the middle of earnings season, you know, they can be much more dominant and reflective of those issues than they are what we're talking about here in the macro data. I think when you look at the 2-year, that's mapping to Fed expectations, and that's a pretty good message. I think when you start looking across into the equity market, you got to be a little bit more aware that, you know, there's other factors going on in this environment of very concentrated equity valuation within the indices that can kind of lead to a misread across from the macro data.
Jeff Rosenberg of BlackRock, thank you so much for being with us. And as Jeff was talking about, the chances of a September Fed rate cut were increasing yet again to 76% now from 40%. Stephanie Roth of Wolfe Research here with us. For a final thought, you've been parsing through all of this. Notably, the 3-month average of the net change in jobs has fallen to its lowest level going back to July of 2020 or June of 2020. What's your takeaway?
I think the labor market has softened. A big part of it has to do with immigration. Another big part of it has to do with government. About half of the revisions are driven by the government sector. So we're looking at an economy that's holding up. Labor market has cooled down, and inflation is going to be heating up. This is a really challenging backdrop for August for risk markets.
Anne Marie, the president's responding. He's coming out on Truth Social.
Yeah, he's not exactly saying what's happening in the jobs market, but he's signaling this is the reason why he thinks the Fed is, quote, his words, too little, too late. Powell is a disaster. Drop the rate.
And meanwhile, the S&P not even responding. It's all about big tech.
No, not responding at all. Again, you would have no idea that this piece of data came out. It is the bond market that is responding, sending us to a more than 70% odds that we will get that rate cut next decision.
Stephanie Roth of Wolfe Research, thank you so much. Coming up on Monday, Ed Yardeni of Yardeni Research, Michael Gapin of Morgan Stanley, Michelle Meyer of the MasterCard Economics Institute, and Vinu Krishna of Barclays. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
A cidade estava sitiada.
Nisso ao começo eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
In case you missed it on Bloomberg Insight.
losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Non-farm payroll revisions drop 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a downside surprise in July's payroll, helping make the case for the Fed to resume rate cuts. President Trump's tariffs kick in. The U.S. rates on goods across the world are set to rise to the highest level since the 1930s, and Amazon disappoints, while Apple surprises to the upside, wrapping up a blockbuster week for corporate results. Katie, you're watching.
Let's take a look at what those shares are doing, because Apple, it reported its fastest quarterly revenue growth in more than 3 years thanks to strong iPhone sales. It expects tariffs to add $1 billion in expenses this quarter. Amazon, for its part, it's trailing the sales growth of its cloud rivals as investors look for results from tens of billions of dollars in spending for AI products. You can see Apple shares actually up a little bit pre-market. Feels like we haven't seen that for a while. And then you take a look at Amazon really taking a beating right now, down about 7.7% in the pre-market.
I feel like I cared a lot more about that before 8:30 this morning. But we are focused on stocks, 30 minutes until the start of stock market trading. And Figma is one that was a massive success story yesterday. Or if you look at it a different way, they left so much money on the table, extending gains today after a 250% IPO pop yesterday, giving the company a market cap now above $50 billion. But Katie, it's really the jobs numbers that are front and center for this market.
Absolutely. 2 points. I feel like Figma CEO Dylan Field still made out okay. I think he's doing fine. Let's get back to that
Just
jobs
left $3 billion
data,
on the table. No big deal.
Yeah, it's okay. He'll make it up. Anyway, this morning's jobs data came in much weaker than anticipated at 73,000, but it's the revisions that people are really focused on. Those downward revisions put the average rise in payrolls at just 35,000 over the last 3 months. Let's take a deep dive into the data with Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, we were talking off air about how there's always a margin of error when it comes to these figures, but boy, those revisions look really ugly.
The revisions are really ugly and really interesting. We had just 14,000 jobs created in June, according to the revised numbers from the BLS. It was 147,000, took everybody by surprise when we first got those numbers. Private payrolls, only 3,000 in June, 83,000 in the month of July. Private payrolls were 74,000, half of what was created last month. So it is a major, major downward revision to the strength of the labor market, which was something that Jay Powell was touting at Wednesday's news conference. Now, the unemployment rate is just 2 basis points, less than 2 basis points, really, from 4.3%, almost a bigger jump there. We went to 4.2, which is a rounded number, 4.248. It does show you that we did have a lot of people losing losing jobs during the month, and we almost got a much bigger move, except for the fact that the labor force went down significantly again, 38,000 after 130,000 in the month of June. The only good news was that we saw wages rise a little bit more than anticipated, and that may be because if the supply isn't there, you got to pay up a little bit. The interesting number in terms of the labor force, though, 341,000 people who are foreign-born left the labor force. Not all of those were deported, obviously, but people staying home perhaps because they're afraid of getting arrested. The biggest changes that we saw were in the federal government, down 14,100, manufacturing off 11, administration and support 19,800. We have seen companies announcing that they were going to be losing some administration staff, sort of the middle managers in their companies as they cut back. Restaurants and bars lost 300. That's unusual. The only real gainer, the usual category of healthcare and social services, 73,000. And I want to turn back to something Chris Waller said in his dissent memo this morning as we leave this issue here. When labor markets turn, Waller said, they often turn fast. If we find ourselves needing to support the economy, waiting may unduly delay moving toward appropriate policy. So we are seeing that kind of reaction in the Fed funds futures market. And Waller may be taking I don't know if he'll be happy about it, but a victory lap in terms of what his forecast was.
Well, I'm very much looking forward to your interview with Beth Hammack, which is just coming up in just a few minutes. These numbers, I would say, are pretty shocking, right? I mean,
absolutely.
If you look at we have a function on the Bloomberg terminal, ECAN. You may be familiar with that. And if you look at that, you'll see a big green bar that just continues to grow over time, and that's healthcare jobs. And if you didn't have those healthcare jobs, you would have seen negative numbers in May, negative numbers in June, negative numbers, a loss of a massive amount of jobs in July. So it's only healthcare really that's keeping us up. And as you draw away these foreign-born workers, it's got to be upward pressure on wages.
And I think that would be unintuitive to a lot of people, that a lot of that strength was coming from healthcare. I will say you can see the surprise in markets right now when you take a look at the 2-year Treasury yield, now down about 18 basis points. People really recalibrating their Fed bets right now.
Yeah, absolutely. I mean, if you look across the curve, it's obviously focused on the front end, but massive drops in the 2-year, in the 5-year, even 10-year yields are down at 426. So pretty amazing moves. Michael McKee, thanks very much. You're going to be right back with Cleveland Fed President Beth Hammack. And I want to get to trade now because President Trump unveiled new tariffs across the world, some of those shocking as well. They won't take effect until after midnight on August 7th. So you have like a week to rush out and get a Swiss watch or Swiss chocolates because it's a 39% tariff on Switzerland. Joining us with more on this is Brendan Murray. He's our global trade czar. And Brendan, I guess some of these were unexpected, but we knew that tariffs globally would rise to about 15%, right?
Yeah, exactly. That's where we wound up. The big surprise, like you said, was Switzerland, and we just heard Jamison Greer interviewed saying that, yeah, they couldn't put that deal together, but the Swiss thought they really had it all together. But something happened where they couldn't get it over the line by the deadline today. There were some other surprises. India didn't get over the line either. They're getting hit with a 25% tariff. Taiwan was also close, but didn't get there. Theirs is 20%. So there are some key U.S. trading partners that are heading into the next, the foreseeable future, paying high tariffs if they can't get a negotiated deal. It sounded like Greer said, we're in the implementation phase of these tariffs now and out of the deal-making mode. So, it didn't sound like the door was that widely open for more talks or talks that they think can happen over the next coming days before that August 7th deadline.
All right, Brendan, great reporting. I know it's been a very busy week. That is Bloomberg's Brendan Murray. So taken together, if these are implemented as announced, as our graphic showed, the U.S. TAVR rate on average would be 15.2%. For those keeping track at home, it was 2.3% in 2024 before Trump took office. There's a lot to get to this morning including earnings. Let's talk about Apple posting strong iPhone sales and a solid outlook, but it expects a $1 billion hit this quarter from tariffs. Amazon, meanwhile, is plunging as profit and cloud growth estimates fell short of expectations. Bloomberg Tech co-host Caroline Hyde joins us now with the details. I feel like we should talk about Amazon. I mean, it's nice to actually see Apple in the green this morning, but Amazon, what a wipeout. A lot of disappointment here, especially when it comes to cloud.
And to be fair to Amazon, it met expectations from the street and actually exceeded them on the fiscal quarter that they reported. And indeed, the forecast was looking good, but its operating profit was the weak point, the amount they have to spend. And as you say, the cloud growth was 17%, exactly what the market thought they'd see. When you compare it to 39% growth over at Microsoft's Azure, when you're thinking about 32% growth over at Google's cloud, why is the juggernaut with all the market share just seeing such a lower pace of growth in the cloud area? Why is the capital expenditure not reaping the rewards that we saw at the rivals? I think that's the anxiety here.
Well, they're being graded on the curve, then they're not doing well, right? Because everybody else is doing so much better. They expect operating profit, I think, of up to $20.5 billion in this quarter. And the street's estimate was only for like 19.2. So they could eclipse the estimate, but the street now, after we've seen Microsoft and Meta, wants to see Amazon do a lot better.
Yeah, I think they just wanted perfection. And with that operating profit going from $18.5 to $20.5 billion, that midpoint, well, I think it's $15.5 to $20.5, that midpoint is below where the market wanted to see it more broadly. Look, Andy Jassy is quite often a more cautious kind of a guy. He's also willing to invest and say profit tomorrow, profit the next year, but not right now because I need to invest in my business. For them, it's an issue of infrastructure. They're saying we need more power. We need the issue of getting these things online when it comes to data centers. But we probably wanted to hear a little bit more about how they're managing to win over with the chips that they offer, how many more clients that they're managing to bring onto AWS. And at the moment, he didn't have that much fighting talk. He just said, look, this is a point in time. People don't want that to be the reflective. At the moment, the stock market is reflecting a point in time of the worry that they're slightly behind in this race when it comes to generative AI. Actually, I think one that is unfair on Amazon, given the strides that they've made with their own large language models and their own investment cases.
Well, to that point, if these losses hold Amazon on track to wipe out its year-to-date gains, let's talk briefly about Apple here, because Apple actually a surprise to the upside. Sentiment was so low on this stock, but they actually had some good news to talk about.
They did, and actually the shares are only popping about 2%, so I don't think it's like off to the races. There's still anxiety about tariffs, which both of you have articulated so well. They're saying that's going to be about $1 billion cost in the next quarter. They managed to come in less than their worst case scenario for the fiscal quarter just gone, $800 million of a cost. But we know that Tim Cook and his team are very good at supply chain. Where they're lacking is innovation. They did manage to get China back buying, whether it's the lower priced iPhones, whether or not it's also they're doing well in some of the other areas. The Mac sales in particular, they saw strength. The number one selling product really when it comes to computers in China. But what about the next iteration? They were woeful in time. The iPads was down. We saw generally the smartwatch and the home appliances not doing well. We need to get that foldable phone. We need to get the latest watch out the bag. We need more AirPods.
All right, we need more AirPods. Good to leave it there. Caroline Hyde, thanks so much for joining us. She co-hosts Bloomberg Tech. That kicks off at 11 a.m., so just an hour and 48 minutes from now. Coming up, Cleveland Fed President Beth Hammack discusses the state of the economy and pressure from the White House to lower interest rates as the jobs market kind of does it for her. Plus, we'll speak with Labor Secretary Lori Chavez-DeRemer after the huge payrolls miss and big downward revisions. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Well, we welcome our Bloomberg TV and radio audiences worldwide. I'm Michael McKee. Joining me now is Cleveland Fed President Beth Hammack. And Beth, if we only had something to talk about this morning.
I mean, it's been a really quiet morning.
It's been a quiet morning.
Yeah.
Were you gobsmacked by these numbers?
It was a disappointing report, to be sure. But when I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data. We look at the longer-term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully.
Well, the one thing that caught everybody's attention is the revisions. We went from 147 in June to just 14,000. And I want to point out the statement from Chris Waller earlier today on why he dissented. He had a line in there that said basically, when labor markets turn, they often turn fast. Does that suggest maybe that you made a mistake by not moving in July?
I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance. Again, today's report is just one report. We'll watch it carefully. We'll look to see if the dynamism in the labor market is picking up, because that's been something that we haven't really seen. If you have a job, you're able to keep your job. But if you don't have a job, it's harder to find one. But in aggregate, we're still seeing unemployment in that 4.2 range where it came out today. But it's been 4.1 to 4.3 for the entire year. We're seeing pressure on the inflation side of our mandate. That's where our miss has been bigger, and it's been lasting for longer. We haven't hit on inflation in 4.5 years. And when I'm out talking to people across the district, whether it's Wheeling, Toledo, Cincinnati, what I hear from people is that the pain of inflation is really biting. They're making very difficult choices. They're trading down from buying ground beef to buying hot dogs. The $400 emergency fund that they have, they're not able to stretch as far as they used to. And so we have to balance those two sides of our mandates when we think about setting correct policy. And we have to look at, if we're missing, by how much and for how long do we expect those misses to last? And right now, we're missing by much more on the inflation side than we're missing on the employment side.
That was basically sort of the message that Chairman Powell gave on his Wednesday news conference. But we're looking at backward data always, of course. Looking forward, to get back to what you were saying about when you're talking to people, what are companies telling you about their plans? Let me put a two-part question. Does the poor job numbers that we got for the last 2 months now comport with what you had been told by companies? And what are they saying about what they're going to do about tariff price increases?
So what we've heard from businesses consistently is that uncertainty has been high for all of this year. They've had a difficult time making investments, executing on the plans that they had going into this year because they just didn't know where the economy was going to go. They didn't know how tariffs were going to impact their businesses. What we've heard consistently is that they fought really long and hard to get their labor force together, to train employees and make sure that they were really able to help produce, and that they're loath to let them go. But that can't last forever if demand ticks down. And so they're watching carefully to see if they're able to continue seeing that demand, if they need to pass on price increases to keep their margins where they need to be. And so I would anticipate that we could see some weakening. It's something we've been talking about and watching for, that we could see some weakening on the labor side of the picture. And if we see that, it would be something that we might want to respond to, again, having to balance that against the inflation side, where we continue to really mess on that side of the mandate.
Well, what's the inflation outlook, basically? Are companies saying we can't absorb too much of this, or are they going to try to hold off as long as possible? Are Americans going to feel the tariffs sometime soon?
Yeah, I mean, my expectation, my forecast is that we will see the inflation numbers tick up. The $30 billion a month in tariff revenues is being paid by someone. It looks like it's more being paid by importers and consumers at this point. I think importers have borne a lot of that to this date, and it's likely that that will start to get pushed. We're hearing from the businesses we talk to that they can't absorb those costs anymore, and they will start pushing that out into prices to consumers. If you look at some of our forecasts, if you look at my forecast, I do expect that we're going to see inflation continue to tick up into the end of this year, and I expect that we'll see the labor market weaken into the end of this year. And again, how we need to manage that really depends on by how much and for how long we're going to miss on each side.
Well, let's talk about your forecast. Were you a 2-dot person or a 1-dot person for 2025?
There are other choices than that. There were 7 people at no dots. I don't usually disclose my dot, but part of my view has been that we see an economy that's operating right around full employment. We've been, reasonably close, not all the way where we need to be on the inflation side of our mandate, and the growth numbers continue to do well. So to me, I think that the economy is operating right around a neutral long-term rate. We're a little bit restrictive. I think I said modestly restrictive, but I don't think we have much further to go to get to a neutral Fed funds rate.
I know that you're going to say 1 month's data are not determinative when I ask you this question, but I've got to ask because the markets are posing the question. We went from 40% chance of a rate move in September to over 70% after these numbers came out. Is September a realistic possibility now?
1 month's data is not determinative. I will in fact say that. But I enter every meeting with an open mind. I think, my job, and I think all of my colleagues around the table walk into every meeting with an open mind to make sure we're looking at the data. And we're going to get an awful lot more data between now and the September meeting. We'll get another jobs report. We'll get 2 inflation reports. And there'll be a lot more time to be out in the district talking with business leaders, talking with community leaders, understanding their experiences to try to put everything together. So I walk into every meeting with an open mind to make sure that we can support the American people and that we can have an economy that's working for everyone.
Well, obviously, the markets today are looking at the labor situation, and you were referencing the inflation situation. If inflation's going up, you can't cut rates. If the economy's collapsing, you have to cut rates. So how do you balance the two right now?
Yeah, this is a really tricky time for monetary policymakers. This is when both sides of our mandate could potentially be in conflict, and we'll really have to look at what is the size of the mess and for how long do we think that is going to persist. And so, again, it will take a lot of conversations with businesses, with community leaders. It'll take a lot of careful analysis of the data. And it makes sense that there can be disagreement at these particular moments because this is really the most challenging time for monetary policy.
Well, I've talked to a lot of your colleagues around the country, and basically they're saying companies are on hold. Now we've got the tariff numbers. Do you have any indication of how fast companies are going to make decisions about what they're going to do in terms of staffing, in terms of investment?
Companies have been making decisions all along. I think they've been delaying or postponing or scaling back from what I've heard. So we have a franchisee who was looking at building new stores, and they decided instead they were just going to renovate existing stores. And so they were kind of downsizing their plans, if you will. Hopefully with more clarity around tariffs and hopefully The policies that we have are durable policies, because that's really important to the businesses that I talk to, that they have certainty in what the policies are going to be against which they're making decisions. So it's possible that we could see some more investment being spurred here, given more confidence in the overall picture.
The other issue that is hanging out there, of course, is Fed credibility and the pressure you're getting from Washington. Donald Trump tweeting this morning that if Chair Powell continues to refuse to lower interest rates, the board should assume control, leaving aside the fact that the board doesn't take, this is not a banana republic kind of situation. How does the board and the Open Market Committee feel about Chairman Powell?
I have the enormous respect for Chair Powell. I know him to be a person of incredibly high integrity, and I know he walks into every meeting and approaches every day making sure he can do what's best for the American people, just like I and all my colleagues around the table do. And so I think each one of us goes into a meeting with an open mind. We have a really rich discussion. We learn from one another. We listen carefully, and people reading the exact same data can disagree. That's what makes markets, and it's no different for, economists or policymakers. But it's a good conversation. It's very collegial. It's very collaborative, and we make sure that we're doing what we think is in the best interest of the American public.
Now, I can't really say what the president is thinking, but he tries to give the impression that if only this meddlesome priest were taken care of, interest rates would go down. You'll be a voter next year. If you get a new chair appointed by the president who comes in and says, I want rates to go down, how will you vote?
I will look at where the data is. I will look at how the economy is performing, and I will approach that the same way that I've approached it all of this year and all of last year, which is to make sure that we're hitting as close as we can on both sides of our dual mandate of maximum employment and stable prices.
Do you worry that the Fed's credibility has been damaged by all of this in the public mind or in the business mind?
I've been really reassured by a number of business leaders and the Treasury Secretary who all talk about the importance of monetary policy. There is a large body of literature about how economies that have independent central banks have much better economic outcomes for their population than ones that don't have that level of independence. What you've seen across the globe is a bigger move towards independence, and so I'm encouraged that our leaders, our business leaders, and hopefully our government leaders recognize that that's critically important for the American people.
Beth Hammack, thank you very much for joining us.
Thanks
the
for having me,
president of the Cleveland Federal Reserve. We'll turn it back to you.
All right, our thanks to Bloomberg's Mike McKee for that fantastic interview. Let's take a look at what markets were doing while that interview was happening. You can see the S&P 500 now down by more than 1% pre-market. Big tech taking an even bigger leg lower, with the Nasdaq 100 off by about 1.4%. But honestly, most of the action this morning is in the bond market. As you can see, the short end of the yield curve really declining this morning. That 2-year yield down 19 basis points. The 10-year yield down 11 basis points. Let's bring all of these questions to BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder, who joins us now. Rick, it's great to have you with us on such a big day. And with the benefit of hindsight, taking a look at the numbers that we got at 8:30, taking a look at the revisions, which are starkly lower than what many were expecting, do you think that the Fed should have cut rates on Wednesday?
I mean, I do. Listen, I think there's a couple things that are salient here. One, the housing market. I mean, look at what we got this week. And, there are parts of this economy that are not interest rate sensitive, and there are parts that are. The housing market is interest rate sensitive. We're seeing mortgage applications, housing starts, building permits at an literally all-time low in many of those metrics. So I think that's a big deal. Second, if you actually strip these numbers apart, and I think Mike McKee said this, if you look at what actually the 3-month moving average, healthcare has actually created on average 68,000 jobs. The total payroll is 35,000, meaning it's created 200% of the jobs, meaning you have a service economy. You think about, is healthcare interest rate sensitive? It's demographically sensitive. So you don't really, you think the interest sensitive parts of the economy are under some pressure. Lower income, who are the borrowers in this economy, are having a tough time. So would I have cut? Yes, I would have cut. And I think, the tail risk is, by the way, I think the economy's in pretty good shape, and I think that's really fair. I think there's some impact from inflation and productivity that's going to pull it down. with a little bit of an uptick for tariffs. The big picture, though, I think, is you can cut the rate. You can get 100 basis points off this interest rate and still be above where inflation is tracking if you look at where break-evens are pricing. So I would have, and I think they will in September.
Do you think they'll cut? Is there a chance, Rick, that they cut by 50 basis points in September? Because I realize it's just one report, but that's what it feels like they need to do this morning.
You stole my thunder. Yes. Yeah, I would. I mean, I think you got to get, listen, I think you should get the rate down. And I think at the end of the day, are you going to stoke more inflation? By the way, tariffs are not exactly interest rate sensitive. I mean, you have this near-term jump on it. Would I get that rate down to something and then see where you are? Yes, I think that's a possibility. I don't think, I've heard people this morning say you could get an intra-meeting. I don't think you would get an intra-meeting. I don't think the economy requires that sort of intense movement. But could you do 50 to get, similar to what happened last year? Could you get that sort of movement? Yeah, I think so. And by the way, I think the economy can handle it. By the way, I'll throw one thing on consumption. High income is what's driven savers. Wealthy, higher income is what's driven a lot of consumption. And you think about higher interest rates, it actually augments their ability to spend. So this idea that you cut it, I just don't think it'll have a debilitating impact on the economy whatsoever, or on inflation, I should say. I don't think it'll have any debilitating impact.
And Rick, I do want to point out, I mean, we keep hearing that it's just one report. We can't make too much out of just one report, but you think about the revisions. I go back to the revisions, really shocking revision when you consider the June numbers being revised down to $14,000, or not dollars, 1,000 jobs. And then you think about what it looks like over 3 months. It doesn't feel like it's just one report here, Rick.
So, man, I think Fed President Hammack is super smart. The smartest I've known him for a long time. The smartest people I've met. And I have a somewhat different view in that and by the way, comments about inflation, I thought were dead right. The thing I believe, though, is if you actually take the broad context of where labor is today, so you look at the JOLTS report, you see job hiring that's way down. But then you don't see layoffs come off that much. Sure. You basically have an economy or a hiring market that's pretty stagnant. Companies are sitting on their labor today. But gosh, if you look at the context, by the way, the reason why claims doesn't move up is because companies aren't really laying off. But if you look at the hiring numbers, gosh, they're pretty soft today. So again, It's not a bad economy. I just think, it's not a 1 month effect.
I just want to point out we're looking at the opening bells here on the New York Stock Exchange and the Nasdaq market site. You're going to see big drops in stocks at the open. Obviously, futures were down bigly, and you have yields coming down at the same time, which is pretty interesting. So it does look like investors are selling out of stocks after this jobs report and using that money to buy bonds because I guess the elementary explanation is they expect the Fed to cut rates just like Rick says they should have and will. And so you want to get in at these levels because the next levels will be lower.
A rotation trade underway. It's also the first trading day of August. We're coming off of 3 straight months of gains on the S&P 500. So a little bit of a drawdown to start August.
62.73.
Yeah.
Wow. In basically one fell swoop, actually a couple of days, we're down from over 6,400.
Yeah, it has been quite a consequential week. Also a consequential week on the earnings front. And let's talk a little bit about Apple because it reported its fastest quarterly revenue growth in more than 3 years, thanks to strong iPhone sales. It did say that it expects tariffs to add $1 billion in expenses this quarter. Maybe that's why you're seeing sort of a restrained reaction in the stock, not a restrained reaction in Amazon because it's trailing the sales growth of its cloud rivals as investors really look for results from the tens of billions of dollars in spending for AI products. That has been sort of the existential question hanging over these big tech names. When are we going to see some ROI here? Amazon shares down about 6.7% at the opening bell, Matt.
Yeah, Amazon down, Nvidia down, Broadcom down, Meta down. So you're seeing a big drop. Alphabet down as well. Figma, on the other hand, is extending gains. It was up 250% yesterday and a huge pop on the first day of trading. The company now has a market cap of above $50 billion. And let me just put this question to Rick, because I know what you think about it, Katie. Rick, Figma goes out and sells stock at 33 bucks, I think a share it was. Now it's trading at 137. They raised like 1.2 billion, but they could have raised $4 billion. I know it's good to get $1.2 billion, but if you look at it like you could have had $4 billion, doesn't that make you a little bit mad?
You know, that's a hard question. I mean, I spent a bunch of time. I can't talk about individual companies. I did spend a bunch of time looking at this company. There's some amazing technology companies, this one included, coming to market that I just think we're going through this extraordinary innovation, technology, productivity. You look at companies like this that have the ability to change, how we do certain parts of software, et cetera. Listen, I'm blown away. I think I said on Wall Street Week last week, and I was in LA the week before visiting technology defense companies. The world, by the way, this is part of my thesis around productivity and innovation, and inflation is going to come down on the backside of it. But yeah, I mean, I think it's the most exciting time I've ever seen to invest, because you're seeing so many of these new technologies like this one that are game changing, I think.
All right, Rick, hang tight. We're coming back to you in a couple of minutes. That is BlackRock CIO of Global Fixed Income, Rick Reeder. But right now, we want to turn back to the labor market. The U.S. economy added just 73,000 jobs in July, below almost all estimates. And joining us now, I'm pleased to say, we have Labor Secretary Lori Chavez DeRamier. Great to have you with us, Secretary. Let's just start with these numbers, because the figure that we got, that was below all estimates in the Bloomberg survey of economists. To start, what's your reaction?
Well, certainly we know they could have been better. But, we look at the positive, because we still have a net positive, almost 500,000 new jobs since the president took office. Where did we see some of these, gains? We saw them in healthcare. We're seeing them in construction. We are seeing the revisions, I know, is something to talk about. And they were unexpected, those revisions. But most of those, 62% of those, were in education and seasonal workforce. So, we sometimes see the numbers catch up to what's on the ground, but I can tell you why we're positive is because the president is delivering on these trade deals, these tariff deals, understanding new countries are moving forward and wanting to be at the table. And why does that matter to the American business owner? As you all know, I've been on my 50-state tour. I just returned from several states. A lot of these business owners had some uncertainty in understanding what was going to happen. But now that the One Big Beautiful Bill is done, I feel like the table has been set, and we're seeing those investments happen. So we've seen positive job growth for sure, and they've been for the American workforce. Native-born workers are taking the lead. All job gains have been native-born workers.
I mean, with all due respect, the positive job growth, the most positive months you saw were still what the Trump administration was calling the Biden economy, right? For the first few months when we saw those big numbers, that was the Biden economy. Now that the Trump policy is taking effect, you're seeing downward revisions of 258,000 over the last couple of months. Only 73,000 jobs added. And it looks like, not just to me, but to participants in this market, that today's weak payroll numbers are a direct result of the conscious policy to limit immigration. And I'm just wondering if that trade-off is delivering the kind of benefits you want to see to U.S.-born workers.
Well, I can tell you this. I've been a business owner for 20 years. When we make decisions, we look at all aspects, and there's certainly snapshots. But what has happened on the ground? The One Big Beautiful Bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money. But they're concerned with borrowing that more money. So that's another leg of the stool that can be done. We should all be rowing in the same direction.
But is it the only leg of the stool that matters, Madam Secretary? Because we had a 3-month run rate adding 150,000 jobs. And now that those policies that this administration has put into effect are active, we're looking at a 3-month run rate of 37,000. So it's drastically fallen. And what it looks like is the policies that you're putting into place are reducing job growth.
Strong job growth has happened, 3.9% over the last year. Consumer confidence is up. Unemployment is holding steady. Again, almost 500,000 new jobs have been added since President Trump has leaned in. I can tell you this, it's not the only leg of the stool for interest rates, but it's one of the important legs right now, because as businesses now know that the table is set with the One Big Beautiful Bill, they know that they can have the write-offs for their businesses. They understand that they will have the skilled workforce. My job on the ground is to provide that workforce. They're asking me, and I'm asking them, to invest in their workers, invest in their companies, invest in their businesses across the country to grow this economy, and that's what they're looking for now. They want those interest rates down, and Jerome Powell should do that. The president has leaned in for a reason, and that's to keep those promises that he made. We're going to continue to see over time those numbers go up. But what we've seen, federal jobs have been down. That's what the president promised. We've seen local economy. We've seen 84% of the job growth has been in the private sector. Why? Because the president has said that he is investing in the American worker first. That's what we're all about. I want these workers trained. We're seeing it in AI. We're leaning in with our federal and state partners together to say, let us give you the workers that you need for market demands in your respective states.
Right.
I think that that's the focus that needs to be.
Well, Secretary, I want to talk about some specific industries here. One of the interesting stats out of this numbers report is that without healthcare, actually the last 3 months of payroll gains, it would have been negative in May, negative in June, and negative in July. And then you take a look at manufacturing, shedding another 11,000 jobs. You take a look at the 6 months change, shedding 28,000 jobs. What are the specific policies that the administration has and is putting in place to revive the manufacturing sector? Because so far it looks like it's continuing to shrink.
Well, I think that that's probably what we just talked about. Those trade deals are now coming online. Again, I was just in Japan last week with the Secretary of Treasury, and that trade deal came in. We see the European Union has come in. We're seeing other countries as well. It's that certainty that we have to give businesses that that is being done. And then as well that they're going to have the workforce. So what do we have to do? I'm working with the Department of Education. I am working to skill those that workforce. We're working with our community colleges, our technical schools. And businesses are investing in centers of excellence. They just need a quarter turn for those workers to be trained and ready to go. One of those ways is executive orders to work with our state partners in order to get them trained and really lean in and have them right there on the ground. So when you see the uncertainty or the numbers drop over time, it's a snapshot in time. It doesn't make a trend. We're seeing it over time. The president has this right. The American business owner is believing in what they see. And now with this One Big Beautiful Bill, and if interest rates drop, I think that you're going to see more and more investments. I really couldn't be more clear when I'm talking to these business owners on the ground. I've visited 20 states. They are all excited. They all understand their marching orders now, and that's to invest in the American worker, and we're going to continue to double down and do just that.
Well, it does look like we're going to see interest rates cut at the next meeting. At least the market is pricing that in, Madam Secretary, and we're looking at rates drop really across the curve. Today, the 10-year down around 4.25 is relatively low. With that backdrop and the tax policy of the One Big Beautiful Bill and the deregulation that this administration has promised, what kind of jobs growth do you expect us to get back to this year?
Well, I'm making the assumption that with all of those being in play, when I think about the deregulatory framework that the president also has asked us to do, the Department of Labor has just issued 63 deregulatory actions. In Trump administration 1, 30 deregulatory actions were done over the 4 years. We've already done 63 in the first 6 months. And we're going to be looking to our companies to weigh in on this, because what does the president want? Modernization, streamlining, cost cutting. He wants to be an ally for the American workforce, not an adversary. And for far too long, the Department of Labor or any other agency has not said, we're going to be your partners. So we will continue to go around the country. We will continue to lean in on interest rates, on investments from companies, on the worker, because we want to keep more money in their pockets. And we're seeing that consumer confidence. Wage growth is up. So there's a lot of positive here. We'd like to see better numbers, but we're going to continue to double down so those numbers continue to grow.
All right, Secretary, have to leave it there. Really appreciate your time this morning. That is Labor Secretary Lori Chavez de Remer. Meanwhile, we're back now with BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder. We've already talked about revisions, but I want to talk about them a little bit more. There's a great stat from our Bloomberg Terminal Top Live blog that if you account for the big downward revisions to the last 2 months, payrolls have risen by just 35,000 jobs on average over the last 3 months. That is the weakest pace of hiring since the onset of the pandemic in 2020. If you were just taking the numbers that we get at 8:30 on the first Friday of every month at face value, it's a totally different picture when you get the revisions a couple of months later. And with that in mind, Rick, I mean, how much faith do you have in these figures?
So there's a lot there. So first thing I would say, further comment earlier, 68,000 of the 35,000 is healthcare. Like that, it's just remarkable. Like you said, these numbers are softer. The one thing I will say, people say, "My God, this economy is slowing dramatically." I'm sure people come out with recession talk again, which will be wrong. The one thing I will say is you have an economy that is in a little bit of just wait. Like, you're not seeing layoffs pick up. You're seeing the claims data in pretty good shape. So listen, part of why I think we should cut rates is there is a risk you do get stall speed in hiring. And because I think that inflation is temporary, and I think you'll see these productivity dynamics playing. But listen, I'm not really worried about the economy. But listen, I think the rate threshold today is not consistent with what I think it should be. I don't think being restrictive today is the right posture. One man's opinion.
I mean, we're spending 7% of our GDP in deficit, so it's unlikely that we go into a recession, right?
Yeah, I mean, there's a series of tailwinds to the economy. By the way, looking at the numbers, there was disappointment on Amazon today. These numbers, I mean, you think about what we just saw this week, the CapEx, the AI, the cloud, the new company that you talked about, new companies that you talked about. The economy, the foundation of the economy is pretty darn solid. I'm not really worried about it. It's created, I did a presentation yesterday called Potholes versus Sinkholes. This is, by the way, this period of time, July is historically the weakest month for payrolls, and actually August is second. So, and the data tends to be weak during this period. People shouldn't overstate that, what it means broadly. So, you go through these periods, you'll get some potholes. The fact that volatility was priced so low over the last few days was pretty remarkable. I mean, the ability to actually put some insurance in the portfolio for this near-term softness was pretty profound over the last few days. But I'm not worked up about, gosh, we got a tough economy coming. Particularly when you see the numbers you're seeing on CapEx and R&D spend.
I want to go right there to CapEx and R&D spend to some extent. AI CapEx has been just eye-popping numbers. 85 billion from Google, 70 billion from Facebook. Next year they want to do 100 billion. Is that money going to really power the U.S. economy? Is that like when we built railroads and highways? Or is it something else, Rick?
Listen, I shouldn't overstate it, but I think that the amount of money that's going into more efficient technology. By the way, you think about what's going into space technology. You think about the power required to actually create this and what it means for different parts of the power infrastructure. Listen, the numbers, like you say, are staggeringly large. I went through it on this call yesterday. I went through the sheer numbers we're going to see and the acceleration of numbers you're going to see. What does it mean? And by the way, you can get into the discussion, is there some near-term inflation as he's put this money into the system? 100% possible. You hit the other side of the mountain when you see and by the way, I think we're seeing it today, some of the productivity enhancements. So the numbers are big, but they're not just the numbers you spoke to, but which are large. It's how do you think about compute, cloud, energy, et cetera. And I mean, listen, I think this is one of the most extraordinary technological evolutions, similar to telephony, similar to internet, similar to rail. I do.
Rick, we probably only have time for one more question. You've been so generous this morning. So I want to take a pretty dramatic left turn here and talk about the concept of privatizing Fannie Mae and Freddie Mac. There's been a lot of talk of that. Our reporting shows that President Trump met with some of the big bank CEOs this week to discuss that topic. You own a lot of mortgages when you take a look at Bank. That is the ETF that you managed. When you think about this possibility, are you concerned at all that it will be executed in a way that could cause MBS spreads to widen?
So a couple things. By the way, y'all have been kind enough to give me a break, so I've been trading in this market, which is which has been interesting, exciting to say the least. It's like an incredible trading environment. So am I worried about? No, I'm not. I think, whatever happens to the GSEs, I'm pretty confident that people understand the preservation of a housing market that, quite frankly, today could use some commercial push. I think is but to maintain some form of implicit or true guarantee, I think people understand that has to continue, and so though I'm not worried about it at all. It'd be interesting, the developments around what happens, how it happens, how they build capital over time, and what those entities look like in terms of other things at their disposal. But the one thing I'm definitely not concerned about is, gosh, the credit quality of our mortgage position, of our agency mortgage position. By the way, not concerned about our non-agency mortgage position either, given so many things around HPA, et cetera, in the housing market.
All right, Rick, we'll let you get back to trading in this market. Good luck out there. Have a great weekend. That is BlackRock's CIO of Global Fixed Income, Rick Reeder. Meanwhile, let's take stock of this stock market. We're about 17, 18 minutes into the session, and boy, it's an ugly one. You do have some gainers right now, some companies fighting to stay in the green, actually about 112 of them. Take a look at what's leading in this market. On a points basis, you have Eli Lilly punching up here, AbbVie as well. Some of these interesting names that normally aren't in this plum position, but you have a lot of tech weakness today, and that's why you see this mix-up here, because NVIDIA currently down 3.5%. That's taking almost 18 points off the S&P 500. Amazon, Broadcom, Meta, JP Morgan as well, really dragging this market down. The S&P 500 now off by 1.6%, a really ugly start to August. Let's take a look at the sector breakdown. It's going to be broadly similar. There is going to be a lot of red on the screen. This isn't typically a screen that we look at. This certainly isn't the sector screen, but trust me, there's a lot of red when it comes to that sector breakdown as well, Matt Miller.
All right, a lot to talk about in these markets on the stock level for fixed income, labor data. Coming up, we're going to talk more about AI spending. The question is it going to pay off? Are we going to see, as you rightly asked, Katie, a return on investment here? Because Mag 7 companies are spending hundreds and hundreds and hundreds of billions of dollars. This is Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what stocks are doing after that big miss for the non-farm payrolls number. You can see the S&P 500 off 1.7% to 6231. So still at a relatively high level, but what a big drop. The Nasdaq down more than 2% right now. And you can see that we have rates coming down, the 10-year yield at 4.25.